Hi, I'm Kevin Kendra, Global Head of Structured Finance and Covered Bond Ratings at Fitch. Each year, our analysts and relationship managers conduct hundreds of one-on-one investor meetings, answering questions on a range of topics from specific transaction performance to regulatory issues to ways we can enhance our research products. Unfortunately, we can't visit all investors, but we can provide market participants with insight into the types of questions investors are asking us and how our analysts are responding. With that in mind, in this new series of videos, I'll be talking with the heads of our various U.S. structured finance rating groups to find out what hot topics are currently on investors' minds and how Fitch is responding to their inquiries. With me today is Kevin Kendra, Managing Director and Head of the U.S. Structured Credit Group, who will be talking about U.S. CLOs. Good afternoon, Kevin. So let's talk about issuance. It seemed like issuance was going to wane a bit this year compared to the post-crisis highs we hit last year. But recently I've seen a number of market experts up their issuance forecasts. What's driving that issuance increase?
Right. So CLO issuance in 2013 reached $85 billion. January and February were slow, but year-to-date issuance has approached $35 billion in 2014. Recent estimates have been as high as $90 to $100 billion worth of CLO issuance for 2014. And that's really driven by the general strong demand for floating rate paper. And CLOs represent one of the few natural asset classes that provide that kind of exposure. We've seen strong demand across the capital structure, particularly in the mezzanine and CLO equity parts of the capital structure. The story at the senior debt level is a bit different in that recent regulations have come into play that have taken some natural CLO investors, forced them to the sidelines as they deal with the new regulatory changes for banks. The net result was spreads widened a little bit on the senior notes. Some new investors stepped into the space, and you now see a current market where there's robust CLO issuance levels. There's enough investors that we're seeing about $10 billion worth of issuance a month.
You mentioned bank regulation, and there was a lot of concern and speculation at the beginning of the year about the Volcker Rule and how that might impact the market conditions. What are you seeing on that front?
Right. So the Volcker Rule has really impacted every aspect of the CLO market. The CLOs being issued in 2014 are all being issued Volcker compliant, and really what that's doing is creating more homogeneous portfolios by focusing on loan-only securitizations. We've seen existing CLOs are being amended now to try to become Volcker compliant, but really we see that there's a significant investor base sitting on the sidelines as they're struggling with dealing with how do they make their existing CLO portfolios compliant with the Volcker Rule.
And what are some of the ways that they're going about or contemplating going about getting compliant with the rule?
Well, the primary way is they have to amend the transactions. What they'll be doing is amending the transactions to eliminate the bond buckets that are the limited allowance for bonds in the portfolios, and they might be altering some of the manager replacement language. The mechanics of doing that can be a little more complicated. You will see that a number of transactions will come up for repricings and refinancings, so that's a natural opportunity for them to actually amend the transaction to allow for the changes to make it Volcker compliant. Other transactions may have kind of limited distribution between the senior debt and the equity, and that's a very likely scenario that they can negotiate with a small number of people around the table. But on the more broadly distributed note, I really think that some of the investors are looking for kind of a market-based solution because it really is difficult to get all of the different constituencies to kind of line up to amend a transaction to make it compliant with Volcker.
Let's transition for a little bit to the credit quality side. In other asset classes where we have seen significant increases in volume, that's been accompanied by increased competition among the participants and inevitably by a decline in credit quality. CMBS is an example of where we're seeing that. Are we seeing something similar on the CLO side?
On the underlying asset class, the institutional term loan market has grown to about $800 billion this year. That's up from about $575 billion in 2012. So despite all that, corporate credit fundamentals are still intact. They're really taking advantage of the favorable lending conditions in the market. And they're really kind of reticent to use cash or free cash flows for, other expenditures, capex expenditures like property, plants, or other equipment. So as a result, they've been very kind of cautious about how do they actually invest in the future with, relatively low GDP growth opportunities. But one way CLOs differ from a lot of the other asset classes is that the assets in the CLOs are syndicated across a number of different constituency bases. So you have retail funds, you have separate managed accounts, other CLOs, and even banks holding the same part of the syndicated loan.
Now, we can't talk about credit quality in CLOs without the idea of cov-lite loans coming up. Certainly, it's in the headlines constantly. What's your impression of that trend, and do you think this is something that investors should be concerned about?
Right. So when we look at the leveraged loan market, the three main areas that we're looking at spreads, we're looking at leverage available to the corporate issuers, and we're looking at documentation standards. Spreads have tightened in. We've seen some repricings, but they're still maintaining. The spreads we're seeing for single B credits are within historic norms. Similarly, on leverage, we're starting to see leverage creep up, but it's still well within historic norms. Documentation has been well documented. The large volume of covenant-lite loan issuance. I think since 2012, there's been over $500 billion worth of covenant-lite loan issuance, and that represents about 60% of what's been issued in the marketplace. So it clearly has been more prevalent in this market. In fact, it has become a common feature of the current loan market. So the primary concern for CLO investors really are limitations on covenant-lite loan exposures impacting or potentially influencing adverse credit selection in the portfolios. What we've seen happen in recent years is the allowance for covenant-lite loans in the CLOs, CLO indentures, have increased from an average of 40% in 2012, and now it's the average we're seeing is around 55%.
Right. So I think most people assume that covenant-lite equals worse credit quality. Is that our impression?
No, and that's one of the things that I think that can be easily misunderstood. People measure or they talk about covenant-lite loans because it's easy to measure, but it really doesn't talk to the quality of the covenants that are in the overall financing package. So it really is a story about looking at what are the quality of the covenants. Many of the fully covenanted loans that you're seeing in the marketplace, there are reasons why they have all the full covenants, and it really is not a metric to look at to gauge credit quality. Another aspect on covenant-lite loans for CLO investors to be aware of is that we've seen a trend where they've changed the definition of what a covenant-lite loan is in the CLO indenture. And what I mean there is where they allow for the accounting of senior secured loans that may be covenant-lite, but if they're pari passu with another instrument that has the same seniority, that does have full covenants, it's not accounted as a covenant-lite loan in the CLO portfolio. We studied this a while back, and we looked at all of the portfolios that we had under surveillance. And what we saw is that CLOs that had the looser definition of covenant-lite that allowed for the pari passu language in it really underreported their covenant-lite loan exposure by about half. So while we see that it's a concern, the concern for most managers has been that they don't want covenant-lite loan limitations to really impact the credit selection process. We've seen an innovative way that they've changed the definition of how do you account for covenant-lite loans. So it really has not been an operational constraint for them.
I know that you and your team have spent a tremendous amount of time in outreach with investors and various market participants. One of the key things that you focused on is hosting CLO manager and CLO investor roundtables. What sort of feedback are you getting from those discussions with investors, and what kind of things are we trying to develop to address those?
Right. So the common theme, I would say, that we're hearing from CLO investors are they want greater transparency and greater comparability across the deals. Now, what we've really attacked that in two different ways. Some of the things that the frustrations we were hearing were related to comparing two CLO indentures side by side. So we came up with the concept of a CLO indenture abstract. And what that does is it breaks down the CLO indenture in a standardized manner, gives our interpretation of every structural feature embedded in the CLO indenture, and allows investors to compare two CLOs side by side, same format, normalized information. Another initiative we launched were the CLO Asset Manager Handbooks. We just published the second edition, and that really puts the same asset manager information, the AUM information, the how they've grown their company, and how that platform, the CLO platform, fits within the larger corporation, puts all of the information in the same format so CLO investors can quickly just go through and reference and compare two different managers.
So as we wrap up, why don't you give us your back of the envelope outlook for the rest of the year as far as U.S. CLOs go?
Right. So Fitch's outlook for CLOs still remains stable. Corporate credit fundamentals are still relatively strong. We see ourselves, still in the middle of a credit expansionary period. So we're seeing things like a little bit of spread compression and leverage creeping up, but not nearly to the point of where we see systematic risk, high systematic risk in the underlying leveraged loan market. Defaults are low, but we do expect to see strong demand for leveraged loans continue, strong demand for CLOs continue, and strong issuance to continue on the back of the strong credit fundamentals.
Kevin, thanks very much for giving us your perspective on our discussions with investors. If you have any additional questions or for more information on the research Kevin spoke about, please contact us at the email address on the screen. Thanks for watching.